The stock market can be a wild ride, full of ups and downs that can make even the most experienced investors feel like they're on a roller coaster. But even seasoned investors were stunned when, seemingly out of nowhere in a single day, trillions of dollars in value evaporated. It was as if the financial world had been turned upside down in the blink of an eye. It was a stark reminder that markets can turn with breathtaking speed, leaving no time for anyone to react. One moment, everything's rosy. The next, it's a sea of red. The sudden shift was both shocking and devastating. This wasn't just another dip, it was a full-blown plunge. A nosedive that left everyone reeling. And it sent shockwaves across the globe. The impact was felt in every corner of the financial world. The financial press scrambled for explanations, trying to make sense of the chaos. Analysts were glued to their screens, poring over data, searching for clues. And ordinary investors were left wondering what hit them. Many were in disbelief, trying to comprehend the magnitude of their losses. The date, let's call it Black Thursday, will be etched in the memories of anyone who lived through it. It was a day that changed everything. The question on everyone's mind was simple but terrifying. How could this happen? What could have caused such a catastrophic event in the financial markets? To understand the market's sudden nosedive, we need to look at the perfect storm of factors that collided on that fateful day. It wasn't just one event, but a series of interconnected issues that led to the dramatic downturn. First, a string of disappointing earnings reports from major companies rattled investor confidence. These reports showed that even the most reliable and robust corporations were struggling to meet their financial targets, causing widespread concern. When giants stumble, it sends tremors throughout the market. Investors began to question the stability of their portfolios, leading to a sell-off that further exacerbated the decline. Adding fuel to the fire, central banks around the world, grappling with stubborn inflation, continued their aggressive interest rate hikes. These hikes were intended to curb inflation, but had the side effect of increasing borrowing costs. Higher borrowing costs put a damper on economic growth, making investors jittery. Businesses found it more expensive to finance their operations, leading to slower expansion and reduced profitability. And as if that wasn't enough, simmering geopolitical tensions and fears of a recession created an atmosphere of uncertainty and fear, the ultimate driver of market panics. The combination of these factors created a perfect storm, leading to a dramatic and sudden market nosedive that left investors reeling and searching for answers. The market crash wasn't just an abstract financial event, it had real-world consequences. It sent shockwaves through the financial system, affecting not just large corporations but also everyday individuals. The tech sector, which had been on a tear for years, was particularly hard hit. Companies that were once considered invincible faced unprecedented challenges, leading to layoffs and budget cuts. High-flying darlings saw their valuations plummet as investors questioned their lofty growth projections. The uncertainty led to a sell-off, causing stock prices to nosedive and eroding investor confidence. But the pain wasn't limited to Silicon Valley. The ripple effects were felt across the economy, impacting everything from consumer spending to business investment. Small businesses struggled to stay afloat, and many had to shut their doors permanently. Retirement accounts took a hit, and many people saw their hard-earned savings dwindle. The financial instability made it difficult for families to plan for the future, causing widespread anxiety and uncertainty. The crash was a stark reminder that what goes up can come down, sometimes with a vengeance. It underscored the importance of financial preparedness and the need for a diversified investment strategy to weather such storms. Section 4. Weathering the storm. Diversification is your best defense. So, what can investors do to protect themselves from such market turmoil? The first rule of investing is diversification. Don't put all your eggs in one basket. Spread your investments across different asset classes: stocks, bonds, real estate, and commodities. This way, if one asset class takes a hit, the others can cushion the blow. Think of it as a financial safety net. Remember, diversification is not about avoiding risk altogether, it's about managing it wisely. Section 5. Don't panic, plan long-term thinking in a volatile market. In the face of market volatility, it's crucial to stay calm and think long-term. Panic selling is rarely a good strategy. Instead of making rash decisions based on fear, stick to your investment plan. Remember why you invested in the first place: to grow your wealth over time. Market downturns are a natural part of the economic cycle. What goes down often comes back up, and those who stay invested for the long haul are usually rewarded. Section 6. Stay calm and carry on. Seeking expert advice. Navigating the complexities of the stock market can be daunting, especially during times of turbulence. Don't be afraid to seek guidance from a qualified financial advisor. They can help you assess your risk tolerance, develop a personalized investment strategy, and make informed decisions. Remember, knowledge is power. Stay informed about market trends and economic developments. The more you understand about the forces at play, the better equipped you'll be to weather any storm. Stay calm, stay informed, and stay invested for the long haul.